How you going down there, Daniel?
Yeah, very good.
That's good. All ready to go? Not too bad.
Yes, I'm fine. Fine, thank you.
Everyone enjoying their lockdown?
Whole eastern coast.
Okay, I think we're ready to go. Well, good morning, everybody. Thanks for joining us. My name is Steve Hundy. I'm one of the partners at Worrells Solvency and Forensic Accountants in New South Wales and the ACT. Also joining us today are partners and staff from across our other Worrells offices. On screen with me, we've got Daniel Alcock from our Melbourne office and our special guest presenter, David Martin. So this morning's topic is how well insured are you as the trusted advisor? What's in, what's out, and what do you need to look out for? To those of you who are joining us for the first time at one of our webinars, welcome. And for those who are joining us and have attended on previous occasions, welcome back. And we appreciate you all joining us more than ever at this time, given the demands on personal and professional lives at these trying times. So while we're unable to run our full normal schedule of events in all locations across Australia, we're grateful to have this forum to be able to connect with you and to continue to be able to provide the educational content that you've come to expect from Worrells. Before I introduce and hand over to David, just covering off on some operational issues. If anyone encounters any technical issues, we're recording this webinar and it will be made available at its conclusion. And you're also welcome to distribute that to any of your colleagues who may be unable to join us today. If you have any questions throughout the presentation, please submit those through the chat function and we will attempt to get to those or as many of those questions before the end of the presentation. If we don't get to your questions, we'll endeavour to get back to you, or one of the partners from Worrells will get back to you via phone or email in the coming days. And finally, we'll be emailing CPD certificates out to assist you all with meeting your ongoing continuing professional development requirements. Now, I'd like to introduce our guest speaker, David Martin. David is an insurance professional with 20 years of in-depth exposure to professional indemnity and directors and officers insurance in Australia. His background as an accountant and having established and run his own IT services companies means he has quite a unique perspective on insurance and risk management from both sides of the table. His team runs one of Australia's largest insurance portfolios for accountants, financial planners, fund managers and other AFSL holders. He provides support and advice to claims challenged clients and has acted as an advocate for individuals and associations alike in their dealings with underwriters and solicitors. He has also been consulted by and provided strategic advice to associations, underwriters and government agencies alike in the industries with which he is a specialist. And with that, I'll hand over now to David.
Thank you very much, Stephen, and welcome all. Thank you for having me into your, well, I guess for those of us on the East Coast, probably into your lounge room, or if you've got children, into your car perhaps, or a cupboard. Pleasure to be here. Look, I understand today we've got a variety of people in the audience, accountants, financial planners, potentially some lawyers, fund managers, insolvency practitioners, of course. And I guess one thing that you've all share in common, you're in an industry which is suffering from a very challenging insurance environment when we're talking about what we call professional lines. And professional lines is typically professional indemnity, directors and officers, or management liability, as it's often called. And look, the third in the Holy Trinity is cybercrime, but we're not actually going to run through cybercrime today. I believe that's the subject of a later submission or a later presentation. So today we'll work through PI and D&O, the differences there. Where are we now? You know, what's the industry? We all know what the industry looks like, but we'll have a look at why is it looking like it is now. What's the future look like? It'll determine essentially how you need to behave, how you need to operate, and we'll talk through the renewal approach, your renewal approach, and a claims approach in the event you end up getting some sort of a claim further down the track. So they're the key elements I want to work through today. We'll talk about some specific claims examples on the journey, and we'll just get started straight into that now. I'm not going to run through a lot of the real detail in terms of how all the key elements of the policies. What I'll do is I'll assume some knowledge there to begin with. But one of the things we will certainly do is touch on the key elements that you need to think about, and probably have some serious conversations with your fellow directors or with your insurance broker or your underwriters. So if we start with professional indemnity, first of all, fundamentally, professional indemnity has got a compensatory and a defence costs element to it. And the basis of professional indemnity, you've provided advice to somebody, they've followed that advice, and they've suffered a financial loss. The key words there are provision of advice and a suffering of a financial loss. With regard to the two elements that are included in the policy, compensation is obviously the compensatory element. Defence costs, very important because they work out at 25 to 50% of the total claim typically. So if there's $1 million claim paid out, you will typically find there'll be another $250,000 to $500,000 paid on top of that. So the defence element is quite substantial and clearly very, very important to the whole process. There are a number of other elements that are incorporated into the policy, things like loss of data, which is not someone suffering a financial loss, but it's been incorporated into the policies as well. There are elements like fidelity and crime. Now, fidelity and crime, I've asterisked them there, not because there's a little item down the bottom indicating what it actually means, but fidelity and crime are similar. Fidelity is your staff stealing from you, or your partner, manager, whatever, stealing from you as the insured, whereas crime is your staff stealing from a third party or from yourself. So there's quite a distinction there. At the end of the day, crime is not always included in PI. Fidelity quite often is. Crime will generally, you can get it included, but it may well be sitting under your management liability. But that's losses that have been incurred by third parties, say your suppliers or your clients. Important to understand that distinction. So who is the insured? I mean, typically on a PI policy, the insured is the company, the legal entity, and just ensure that it is the correct legal entity. A trading name is not a legal entity. That won't be engaging, have a responsibility to a client. A company will, or an individual will, but a trading name will not. Subsidiaries and associated entities, generally automatically included, generally, not always. And just be sure if you do have subsidiaries that you're clear on what your underwriter considers a subsidiary to be. Chubb, for example, say you've got to have exactly 50% or more ownership of the entity in order for it to be considered as a subsidiary. AIG will look at a more traditional, if you've got control of the board or if you're consolidating accounts, those sorts of things, and they will treat it as a subsidiary. So there can be differences in the two. Just make sure you're clear on those. Directors, employees, subcontractors, etc., will generally be incorporated. Well, sorry, directors and employees will always be covered. Contractors can be covered, usually are, providing they're providing those services through to yourself. There are a whole bunch of other elements which we're not going to go through in too much detail, but the important point that the two important points out of all of these elements, claims made. It's a claims made policy. So what that means is that the policy will respond to the policy that the underwriter that's in force the day you find out about the claim is the underwriter who will respond to that claim. Doesn't matter when the work was done. What matters is the date that you were first made aware that somebody had a claim against you. And that's a really important concept, because if you've sold your business, if you've retired and you get notified with a claim, after that process has gone through and you haven't got any insurance anymore, you have no cover, because the insurer who is responsible the day you were notified of the claim is the one who's going to respond. Look, the other important point I'll make to you is just ensure that the services that you have noted either on the application form and generally on the schedule are the services that you actually provide. If you're providing insolvency or M&A services, etc., or financial planning, mortgage broking, etc., and those services aren't specifically noted on the schedule, then in all likelihood, in the event of a claim, you're probably going to have a fight with the underwriter. So it's incumbent on you to just ensure that those services are actually noted on there. So make sure that the policy is fit for purpose is the key thing. So, management liability. Now, we utilise the terms D&O and ML almost interchangeably. They're slightly different. Directors and officers, or D&O, is the actual US version. Management liability is almost universally utilised in the UK as a description of what this is. But typically, these products cover you for actions where failings, I guess, in your management of the business, and so eventually, inevitably, if you've created cost or cost external parties or internal parties as a result of the failings in your management of the business, that's where a D&O and a management liability policy will step up. There are 4 sections typically that are covered under that, and we'll talk about that on the next slide. But the main people that take action against an entity are clearly going to be employees, creditors, shareholders, or partners. And just a word on partners taking action against partners. Some policies don't allow it, but most policies do allow some element of an insured on insured action, is what we call it. There is an innocent parties clause in most of these policies which says if you're the partner or the shareholder in this particular entity and you didn't do anything wrong but one of your other partners did, generally the underwriter will actually step up in to defend you, compensate you, and then seek to recover from the guilty party. That's basically the way it works. The other actions that you can see initiated are generally from the regulators, Fair Work, Workers' Comp authorities, ASIC, etc. And you obviously get litigators and insolvency practitioners involved as well. If a business goes into it becomes an insolvent entity, we are seeing quite regularly some action, some inquiry at least from the insolvency practitioners. So as I said, there are 4 sections that we make up a management liability policy. There's a directors and officers section, and don't get confused with the generic term. This is almost a subset of the policy. Directors and officers, which is side A, cover for the directors themselves. Someone's taking action against a director. Side B, reimbursement of the business for where there's a requirement for them to compensate the director. So the action has been taken against the director, but an indemnity has been provided by the company to the director. So the insurance will step in to ensure that those monies are being paid. And side C is a securities claims cover. Now this is essentially cover for when you're getting action from ASIC or the stock exchange, etc. It's usually listed entities that are taking on these side C covers, and it's really derived around shareholder actions against the entity itself. We are finding quite a movement for larger insurers in this space to actually move away from providing side C cover at all because it's costing them too much. The other 3 elements, 3 sections within D&O policy is the employment practices liability, EPL, as it's often called. Stat liability and crime. Now, we've talked about crime already. Employment liability is probably the most heavily utilised part of a management liability policy at the moment. We're seeing an enormous 70% or something of the claims that come through on an ML policy relate to employment practices. So it is pretty, actually I don't think it is 70%, I think it's about 60%, but it's a significant utilisation in that space. Stat liability is where essentially penalties for breaches of statutes, most of those revolve around occupational health and safety. So, if we look at the ML claims themselves, 59% relate to EPL, and I guess that there are elements such as unfair dismissal. And unfair dismissal does tend to make up the majority, but you get workplace bullying and various other elements in there as well. 70% of the statutory liability claims are occupational health and safety. Now, the pre-COVID, mental health was becoming quite a significant component. If we look at the difference between mental health versus a normal occupational health and safety claim, compensatory payouts were nearly three times as expensive on a mental health claim versus a normal physical injury. Return to work was 15.3 weeks versus 5.5 weeks. Underwriters are exceedingly concerned as to what this COVID environment is going to do to that mental health environment. We're expecting to see substantial increases in claims, etc., as a direct result of that. So the other key element is fraud. We do see quite a bit of action under management liability claims around fraud. And we had a firm in Sydney, for example, a legal firm who had lost $1.3 million over 5 years. They had a bookkeeper that was quietly, would submit an invoice for payment quite correctly, and then 2 months later would resubmit the same invoice, but prior to submitting it, they'd jump into Xero or whatever accounting package they used, change the bank account details, and the payment would be made. Then they'd slide back in and change the bank account details back to the supplier's bank account details, and they continued that process for a number of years. They managed to reduce their company's profit by about 25%. Took them 5 years to find that out. They actually got full restitution from the management liability policy itself, but then post that, the underwriter went back to obviously the perpetrator of the fraud and recovered most of the monies from them as well. So fraud is a key element, I guess, a key defence for the management liability claims policies, but it's also the most difficult one to actually pick up. So that's a little about the policies themselves. Where are we now? If we quickly dive into what the market looks like, and I'm sure I'm telling you stuff you already know, I'm sure, but KPMG release every 2 years a general insurance insight. It provides a really good look at PI, and it's very similar to D&O. There's not quite as much information available on the directors and officers policies, but the trends are almost identical. So if we look at the first one, being gross written premium, you can see, I'm going to try and get my little highlighter to work here. There we go. So you can see a significant trend upwards. The premiums have almost doubled over the last 2 years. Now, it's not just premiums increasing. Of course, the volume of enterprises that require premiums have increased as well. But there's this obvious trend upwards. If you then look at individual premiums, this is where it's affected your wallet. You can see that the overall trend has increased to, gone up 30%. So it's increased from $3,000 to $4,000 on average. We've got outliers. Financial planners, for example, have probably gone up 3 times in that same period of time. And you've got others. The accounting market has remained relatively stable. We've got one facility ourselves, which the policy premiums have not changed in the last 10 years. We are looking at probably a change in the next couple of months. So the impact of that is that standard underwriting, you receive a whole bunch of premiums in, you pay out claims, they're the green bits, and you've got an underwriting overhead that sits on top. When you add all of those together, you end up with this this ratio, the combined ratio, which is effectively saying, well, if you've got $100 worth of premium, how much of that are you actually paying out? What's the profit that's left over at the end of the day? Underwriters like to run on around 90%. That's typically where they'd like to operate. And they will very much go through a process of ensuring that the levers that they're pulling are delivering them that profit over an extended period of time. What you can see from this graph is obviously the underwriters in 2000, and I can hardly see that, but 2017, they achieved those results. Post that, they've been running at something north of 100% every year since. Now, underwriters typically make about 50% of their margin from insurance, so their profits from insurance. The other 50% comes from investing. These are long tail claims. They take a long time to get through. So they invest the premiums that they've taken into generally bonds and fixed interest and term deposits and those sorts of things, looking to make about 3 to 5% margin on those. Clearly in the present market investment environment, those returns have not been available. So you've got underwriters getting hit with claims that have gone through the roof. You can see that in these latter years. And at the same time, the investment markets, which usually would provide them with a good return, have not been actually responding in a satisfactory way either. So we can see here that the claims ratio has been sitting at somewhere around 110 to 120% for the last 4 years. It doesn't bode well. The other thing that's, I suppose, where have they come from? Premium pools are generally not that large, so small claims can have a significant impact. The whole financial planning premium pool is around 55 million is what's required. I personally think we've only got about 48 million available. So we're looking at a whole bunch of claims now related to the Melissa Caddick activity, which I don't think will end up being a financial planning claim, to be honest. She wasn't registered, but they tote $16 million. So when you've got a total pool of $48 million and you take 16 million out of it, a third of it's gone. And you'll see some interesting numbers from AFCA shortly, which will further demonstrate the fact that pressure is being put on these claims ratios constantly. So finally, from an underwriting perspective, you can see that it's not been a happy 5-year period for them. The Lloyd's results are even worse. Legal industry, we've seen a 20% increase in claims in the last 24 months. That's predominantly been driven by more difficult economic situations. So fundamentally across the insurance landscape for PI and D&O, it's actually looking like a fairly sick environment. Okay, so what are the underwriting responses? Well, as I said before, they've really got 3 levers that they can pull on, and underwriters tend to rear view mirror the world. That tends to be the way they operate. So they basically can increase their premiums, of course, and we've seen that happen. They can reduce their claims by reducing the excesses, reducing limits, coverage, etc., or they can exclude markets or sub-markets. Now, when we talk about reducing coverage, what we're talking about is a particular chunk of the policy that they're saying we're no longer going to extend an accounting policy to cover management accounts, for example, management advice, or something more extreme, I guess, would be auditing. We're exiting the auditing market. We're simply not going to cover that under an accounting policy. So underwriters they've done a lot of that work already, and excesses we have seen in a number of industries where we're all very used to $10,000 excesses, suddenly seeing excesses sitting at $50,000 to $100,000. It's not uncommon in a number of industries. So they've done that work already. We've seen a lot of that activity go through. But I guess Lloyd's have in 2018 lost, 2017 they lost $2 billion, 2018 they lost $1 billion. And so they forcibly made their syndicates, they've got 100-odd syndicates, insurance syndicates, they forcibly made them get rid of their worst performing portfolios. They said, if you either do that or you're Why does that matter to us? Well, Lloyd's still write about 40%, 39%, I think, of our casualty insurance in this country. So that's a significant impact. That impact, although that forced activity actually meant that 2019 they ended up with a much better result. However, they then lost it again last year. They had a $1.5 billion loss last year, so it's all turned around again. It doesn't look like it's going to have some significant changes. The final lever they can pull on is reducing overheads and operating costs. As you would have seen, though, that's an instrument that doesn't really provide a lot of benefit to the underwriters. They don't really see huge benefits as a result of that. The sources of claims themselves, I mean, we've had very high profile financial planning collapses, etc. So, these are long tail claims. They take years to resolve. We've really only put the Storm Financial claims to bed, to be honest, in the last 3 years. And it's generally, in all honesty, it's the larger insurers that are generating a disproportionate quantum of sizable claims. Now, underwriters are starting to move down towards the lower end of the table, to be honest, and moving towards mid-tier clients, which is interesting because mid-tiers have always been a bit difficult. Mid-tiers, very small clients have been perceived as not much of a risk. Very large clients have been perceived as not much of a risk, and the mid-tiers are the ones that have always tended to have problems. So we are seeing underwriters starting to favour those mid-tiers more. I think the legal and accounting and technology sectors are starting to feel a little bit of pressure at the moment, and a lot of those claims are driven by the economic situation. They certainly seem to be the case. The legal industry itself is quite interesting in that the Victoria, New South Wales and Queensland, their associations have had a very positive impact in terms of the reduction in complaints, etc. There's this emerging class action and litigation funding environment that we've seen, and Australia is unfortunately ranks equally with the US in terms of being the most litigious business environment in the world, which is quite sad considering we weren't there 5 years ago. And then we've got AFCA. Look, there's a firm, Fourth Line, who conducted a survey which was only released on Tuesday. And look, if you're running a planning or an accounting firm, I'd suggest very strongly you get your hands on this particular report. I'll see if I can include the link to it in the file that we send out. But at the end of the day, that report really goes to, and does a deep dive on the various different complaints, etc., that have come through, and it's quite telling. 2008, we were chugging along with a reasonable set of numbers up until 2018. And in 2018, what happened? That's I think it was November 2018. They increased the maximum complaint limit to $500,000, and you've seen this massive jump in complaint payouts since then. 64% of complaints were found in favour of the plaintiff. And bear in mind, only 44% of life insurance cases were found in favour of the plaintiff. 91% of superannuation claims were found in favour of the plaintiff. So it's become a very difficult environment for underwriters to deal with, and it's obviously a very difficult environment for accountants and financial planners, etc., to deal with it, or anyone who's subject to an AFCA complaint. So moving right along, we'll quickly, we won't spend a lot of time on this, but essentially the insurance cycle works. It's a Keynesian economics model. In a soft market, there's lots and lots of premium washing around. Hard market, there's not a lot. You tend to see a lot of underwriters leave and re-enter the market. And right now, we're sitting at this hard market stage, so we're over in this place here. From a D&O perspective, the premium pool is fortunately now at a level where it appears to be sustainable. There is a capacity shortfall, but still needs to be resolved, and we are seeing some new entrants coming in, and there has been some positive legislative changes. So ultimately, with D&O, we'd be suggesting we're at this point in the cycle, which is we're still going to see some premium increases, I would suggest, over the next 24 months. The next 12 months. But at the end of the day, it's a sustainable market. It'll stabilise moving forward. PI, however, profitability is yet to return. We've got further increases I'd be predicting for the next 12 months of 10 to 20%, and some industries are virtually uninsurable. In order to resolve this problem, we're going to have to re-engage with Lloyd's. We're going to have to get some Australian underwriters to step up and say, yeah, we're prepared to pitch in and carry some of the weight. It's quite a challenging environment for that PI market. So I'm sorry, I don't have a lot of happy news for you here in the short term. From in terms of where is the industry going, we are seeing some new models arriving. Captives, many of you have probably heard of a captive. Some of you may not know what they are. Many of you may know what they are. It's effectively a form of self-insurance, and it's the preserve of the large corporates typically. The numbers of captives have increased 200% in the last 12 months. You used to not see a lot of captives occurring when you had premiums of less than $20 million. And it came out of the oil industry. That's effectively where captives evolved. We're now down to seeing enterprises with about $5 million premiums starting to move into it. So it hasn't got down to the real world yet, I would suggest. It's still very much the tool of a corporate environment, but there's been massive growth. Discretionary mutuals really are collectives, and they're set up by industry or professional groups and who've got common risks. The relevant word here is discretionary. ASIC don't really like them because the discretionary means you don't have to pay the claim. It's run by a representative board, and ultimately they make the decision as to whether that particular claim is going to get paid or not. Self-insurance. If you've got a balance sheet that can support it, then obviously some of the entities and some of the corporates will work through this self-insurance model. They once again, ASIC don't like it, and there is an option for you within RG 126 to actually go through this process of actually submitting an application to provide self-insurance. I've never seen it get up, quite frankly. We are seeing still increased government intervention. Some of it's good, some of it's not. For example, I like to think that the changes to the disclosure rules, etc., are a positive. We're seeing the Know Your Client legislation, though, has become quite problematic for quite a lot of the firms. We are seeing insurtech. By insurtech, I mean insurance that's being offered in a technical environment. We're seeing quite a lot of that occurring and going through at the moment. There's a company in the US called Lemonade, and it's all done it's driven by artificial intelligence and behavioral economics. And effectively what they do is they offer almost like a crowdfunding solution for insurance. It's a wonderful concept. I love the idea. I haven't seen any of that starting to work its way into professional lines at this point, but I think for PI, it's a matter of time. I really do think it's a matter of time. Lemonade, by the way, I think they only do home loaners, renters, some pet insurance and various other bits and pieces like that. There was something released here for cyclists just recently, which I had a look at. Utilisation of artificial intelligence, and I guess this is an area that we're seeing transformational change amongst the underwriting fraternity. And there was Deloitte's released a report earlier this year where they basically took you through what changes were occurring through utilisation of technology in underwriting. And the first thing is that certainly automation added some sort of value, but that was really just pulling it out of the operating cost levels. Underwriters got a much better bang for their buck once they started adding alternate data sources and utilising those alternate data sources in the decision making around risk management. But the thing that blew it all out of the water was once they started introducing artificial intelligence. So that is the future for this industry. That's where, certainly from an underwriting perspective, it'll make a difference. But it's exceedingly positive for, I think, the insureds, because fundamentally, if you're a good insured, if you've got good processes, risk management tools, you're going to get lower premiums. At present, if you're in an industry that's not popular, you get the same rates as everybody else. There might be a little bit of tweaking here and there, but the vast majority, you're getting the same rates as everybody else. So I see it as being a very positive place to be going. I'm going to finish up fairly soon, and I'm going to leave you pretty much with a couple of key points around your renewal process. You will be going through this renewal exercise at some point in the next 12 months. Time is the most critical element that you can look at, especially if you're in an industry that's finding it difficult to get insurance. From a PI and a D&O perspective, the earlier you can get onto this process, the better. We used to say at least 2 months before your renewal. If you've had a claim, if you're in a difficult industry, I'd be suggesting you get in contact with your broker 3 months prior. The other timing issue is ends of years and half years is problematic. You cannot talk to underwriters during that period of time. So it's really important you actually get onto those things quickly. Consider your limits and the excesses you can live with. You may need to deal with higher excesses than you're potentially comfortable with, but it may well be the only way that you can actually get your coverage. If you've got a risk management program, you should have a risk management program. And what you should be doing is A, living it, but B, ensuring that your underwriters are aware of what you're doing. So if you've got well-written contracts, it can be as simple as having well-written contracts which limit liability, managing your staff, having good staff, doing all the boring stuff, accurate terms of engagements that are sent to clients, signed by clients and retrieved and stored. All of those sorts of elements, promote it to your underwriter. If they look at it and think, well, it's going to reduce our exposures, it'll make a difference. Detail is crucial. You may need to write a submission to them. If you've had claims, you must talk about what you've done to actually avoid the claim occurring again. Excuse me. And I think the final point on that is manage your website. Underwriters used to get brochures and they used to go through a lot of detail. Now they jump onto your website. If you've got a website that says you do things this much, I'm trying to make sure I can be seen on the screen, you're doing that, but you're only doing that and they only want to insure that, they won't insure you. So your website needs to reflect what you actually do. We do media searches on all our major clients all the time, just to see what our underwriters will be looking at. So the final slide really is, sorry, not the final slide, the penultimate slide. In a claim, there's not a lot you need to do other than the first thing you need to do is notify your broker. You will then find you'll be in this halfway house where, do I appoint a legal counsel or don't I? My advice is always, if it looks like it's going to go somewhere, appoint the legal counsel, because the underwriters will appoint their own, but they're going to be they're not working in your interest initially. They're working to advise the underwriter as to whether they think you should be covered or not. So they're not acting in your interest at that point. Prior to appointing your own legal counsel, though, get an approval from the underwriter that they're happy to pay the fees for that legal counsel. Either way, you should have someone in your corner actually advising you what to do. Underwriter, as I said, they'll appoint their own legal counsel. They'll go through and act on your behalf if they decide that you're going to be covered, or they'll pay for yours to do it. And they'll manage that ongoing process. So claims, I've glossed over it, but claims is quite a difficult process. The first thing you ought to do really is notify your broker and then get some legal advice. And I think finally, the final slide is prepare for the claim. Work on the assumption that you have a very good chance you will get one. Change your mindset. I've never been sued doesn't work anymore. We've got 8 claims going on the go at the moment. 7 of those have never had a claim before. So it doesn't fly. Be under no illusions. If you do get a substantial claim, your premiums will go through the roof. We're talking 5-10-fold increases, and potentially you may not get insurance. Be clear about the advice you're offering. Don't get outside your swim lane. Don't be afraid of outsourcing. Outsourcing is a solid way to actually maintain your outsourcing is certainly a good solid way for you to ensure that you're still providing the services through to the client and you can retain some control, but you're not actually on the hook in the event the advice is not satisfactory. Understand your policy may not provide cover for allegations. If someone alleges you provide financial planning and you're an accounting firm, then unfortunately your policy is probably not going to stand up, because you don't have the policies generally cover cover acts and allegations of whatever's in the schedule. If it's not in the schedule, it may not get up. I've already talked about doing the boring stuff, but the final point really is record, record, record. If you have really strong centralized data management and good record keeping, contemporaneous notes are a vastly more satisfactory and safer alternative than some sort of a recollection from 12 months prior or 2 years prior, etc. So that recording is probably the last thing that that I'll leave you with. You need to ensure that those disciplines are being followed. All right. So I think that's it from me. I'm going to hand across back to the team and open it up for any questions that we've got. Daniel?
Yeah, thank you, David, for that. Yeah, we've had a few questions come through. One to start off with would be just in terms of that renewal process. Can you share any or have any comments as to any key carve-outs in policies that you may see regularly that are taken for granted?
Taken for granted as in you would assume they're included, but they're not?
Yeah, that's right.
Okay. Look, it varies underwriter to underwriter, of course. I mean, I guess at the end of the day, the description of services is probably the key. It's not a carve out so much. Exclusions will work their way through and be very clearly indicated, or should be very clearly indicated. The ones that do cause problems typically generally relate around deliberate acts and those sorts of things, of course. But I mean, if you've got the directors or the owners of the business that are operating in a manner that's it's quite deliberate, then they're never going to get up those sorts of issues. It's a difficult question to ask simply because it is so dependent on the particular policy that we're looking at the time. I think the key thing is just to ensure it's fit for purpose. I mean, the major services that you're providing are not being excluded, and insolvency exclusions, I guess, are probably one of the key things that in a D&O policy that you want to make sure that they are included if you possibly can. You will need to provide financials and those sorts of things, I would suggest, but yeah, I mean, other than that, there's not really too much I'm seeing on a very regular basis. We do see things we don't like.
Yeah, okay.
I've got another question here for you, David. It's just a very general question. How long do you need to keep runoff cover for?
Okay, runoff cover is look, the statute of limitations, I believe, is 4 years from quantification of a loss, or 6 years from the actual time from the action itself. So generally, runoff cover is purchased for about 7 years, and the way that the underwriters look at it is most of your exposure is going to occur in the first year after a business has provided the service, and it degrades over a period of time. So it's not cheap. It's about 3.5 times your annual premium for a 7-year runoff policy. We have seen runoff policies written for 5 years, and you can buy them year on year. As a director, you've got to be, if you're an exiting director of a business, you've got to be very, very careful. You can insist that the purchasing company purchase runoff cover every year. The issue you run into is if they don't purchase it on the second year. So you're better off if you're selling your business and the incoming entity is going to be responsible for the runoff cover to ensure that there's a 5 or a 7 year period that's in place.
Thanks.
Yeah, look, David, another question that came through was one person wondering what the key issues would be that a professional needs to consider before they join a board of a client or a non-client.
It's a very common question for accountants. You're professional indemnity insurance may extend to you as an accountant providing directorship services to one of your clients or a third-party entity. You have to be careful though, because the laws around shadow directorships, etc. Your accounting policy is really going is only going to cover you for the accounting services you're providing. We always recommend that anybody who's going to become a director of an external party ensures that the external company has its own directors and officers insurance, because that way there's no question. I would hate to be in the situation where you're not entirely sure whether you're covered or not, because when you're an accountant operating as a third part as a director for a third party, the accounting policy is only feeling that you're providing those accounting services. So the minute you start making decisions around what products they should be offering, whether they should be opening the branch in Queensland or not, that's a very different matter. You're not providing accounting services anymore. You are acting as a true director. So the key point I would suggest is that you've ensured that you've read the policy, you've seen the policy that your target company's got, and that it's appropriate for the services that you're offering.
Yeah, great, thank you.
Another one here, David. Are you able to maybe provide any examples for accountants where they've maybe been sued, whether you've got any examples there, and on what sort of grounds, or what was the type of claims that you would typically see, I guess, or?
We're seeing quite a lot of activity for self-managed super fund auditors at the moment, which is a little bit frightening and a little bit unexpected. So we do see, we've got 2 that we're working with at the moment, and unfortunately that's where they've been auditing self-managed super funds, and there's an argument and there's been a failure, and it seems to be where there's certainly there's been fraud perpetrated, and the auditor is being nailed to the mast for providing an audit service and not picking up the fact that these fraudulent behaviours were going on. Now, underwriters, solicitors, and we believe that that's inappropriate. That's not actually the role of the self-managed super fund auditor. And even in one of these cases, they've actually got, it's in their terms of engagement that they aren't responsible for that, the trustee is. But they're still having to go through that process. So we've got a couple of those working through at the moment. It is quite concerning. Accountants' tax advice typically is the biggest issue, especially and the ones that concern us most around capital gains or sales of businesses, those sorts of things, where a baby boomer's cashing out and all of a sudden they're paying a lot more tax than they probably should have if they had. And it's really where an accountant has taken them out of a structure and put them into an inappropriate structure, which has had a major tax implication. Look, they're probably the major concerns, I guess, but it is generally tax advice that is most concerning. There are always a lot of allegations that accountant provided me with some financial planning advice. It starts to cross over into that space, especially around things like property trusts and those sorts of things. So there's a myriad of them, but the biggest concern is generally around taxation.
Yeah, another one there, Dave, was in relation to those who've retired, but they may still be providing some meet and greet type services and give it maybe even some overarching general advice, but they won't actually prepare any returns or do any of the work itself. What would you have to say in relation to that? Would they need insurance?
Well, look, if we're talking about accountants, if you're registered with one of your associations, the associations provide what they call it's a policy for retired members, and it's usually part of your membership fee, and that provides a modicum of cover for, and it's usually for things like voluntary work or just keeping your hand in if you're earning less than $20,000 a year, etc. I mean, PI is not that cheap, and I guess there are a number of options out there. But I would suggest for most members, if you're still a member of one of the associations, that's probably the most cost-effective manner you can operate under. The issue we've got is that we're in a situation now where advice can be being deemed to be being provided around the barbecue, and that's a problem for all the for all the professions, and it's a real issue that means that to some extent you can actually end up providing advice when you don't even realise you're doing it. That's whether you're retired or not. Have I even answered the question? I hope I have.
I think so. Thank you.
And just following on from that, then David, there's another question here about accountants, whether or not if they provide CFO services, so Chief Financial Officer, I guess internal roles, can that also be covered under their PI policy?
Again, depends on the PI policy. It's similar to the discussion we had previously, but I mean, for example, the CGU facility that we offer does extend to cover that. Most policies can extend to incorporate those services. But once again, you've got to be very, very careful. The accountant can't be, the person themselves can't be the one that's actually providing the service. It needs to be engaged from the accounting firm themselves. Any invoices and payments need to be going back to the accounting firm themselves. But the fundamental tenet here is that you're providing advice of a financial nature. So it's not carte blanche. You can't just be they don't like the word CFO, to be honest. They do tend to feel that then you're stepping into the boundaries of actually providing advice at a more direct level. So you've got to be a little bit careful with that, utilising that title. And actually, we're working through some challenges with one of our firms at the moment that provides that as a service, and just to ensure that the policy can extend to cover that. You've got to work with the underwriters on those sorts of things, I guess, are the key points too.
Yeah, okay.
Yeah, Dave, another question I had was just in relation to how the policies may change or do change when you're a sole practitioner versus a much larger firm.
Look, the basic elements of the policy are the same. The coverage, obviously, depending on what the schedule says, the coverage will be fundamentally the same. It will respond in the same manner. I mean, a policy is on an insured, and the insured is either an individual. It's got to be a legal entity, so it's either an individual or it's a company, and it extends to cover any of the employees or any of the other subcontractors, as I indicated before. So it's not that different. The challenge, of course, is ensuring that you've got control of the entity. So, your staff, it becomes an operational issue. Your staff are actually doing what they're meant to be doing, and they're operating within A, the terms of the policy, and B, within the scope of what work you want them undertaking. But from a PI perspective, professional indemnity perspective, it doesn't make a lot of difference. It costs more, of course, but being a corporation, but that's simply a function of revenue. I mean, underwriters tend to rate policies on a percentage of revenue.
Thanks, David. Are you able to maybe explain or give any examples where you've had the limited, obviously we've got limited liability under some of the professional standards schemes.
Mm-hmm.
Yeah, obviously there's a couple of questions in here in and around how that interacts with your own PI
insurance
policies, and whether you've got examples of maybe recent examples you might be able to talk through. Sure.
Limitation of liability schemes. I mean, there's a misconception that it is insurance. It's not insurance at all. What it is, it's a government, semi-government body which puts a cap on how much somebody can sue you for, effectively, And by disclosing to that client, by ensuring you've got that little clause on the bottom of all your invoices and any engagement letters to say we subscribe to a limitation of liability scheme. The most you can sue us for is $2 million. All you're doing is you're putting a lid on it, and it's a legal construct. To my knowledge, it's yet to be tested. We haven't seen any evidence. I don't believe it's actually been tested in a court of law as to whether it will apply. That's the first point. I guess what it does say to me is that, and look, we've gone through this a number of times with the associations. We support one of them in actually subscribing each year. What it does say to me is, look, if you've got a $2 million limitation on your liability, logic says your PI limit should be able to accommodate $2 million, and that's all you would need. What the limitation of liability scheme doesn't do, though, is limit the legal fees that sit around it. So, as I said during the presentation, 25 to 50% of the cost on top of the actual payout will end up being legal fees. So that will fall outside of any cap. That's not actually included in the cap. So you've got to bear that in mind. And I think the other thing to bear in mind is that the limitation of liability will pretty much prescribe how much insurance you're going to have to have. So if they're offering $2 million worth of, the cap is set at 2 million or 5 million, or depending on what how it's put together, it will then prescribe how much PI you will require for that. And it's usually the same amount. So if you've got a $2 million cap, you'll have to hold a $2 million policy on top of that. So it's not an insurance. It's really just putting a cap against how much someone can have a crack at you for.
Great, thanks for that, David. That's probably about all we've got time for at the moment, given it's almost 1:15. Thanks for your engaging presentation today. It's, I think, given us a lot to think about to ensure our insurances are adequate, especially in the current circumstances out there with significant change of how and where we work and operate. To the audience, we'll soon circulate to everyone access for the recording of this webinar in conjunction with providing a copy of the slides and CPD certificates. Thank you for joining us today, and we look forward to hosting you at our next Worrells Webinar Series, Episode 7. It's on the 21st of September, and the topic is data security in an increasingly virtual world and how to protect your identity from theft. It will be presented by Brian Hay, who's Executive Director of Cultural Cybersecurity Proprietary Limited. He's long considered a thought leader in the world of cybersecurity. Invitations that will go out in the coming weeks as well. In the meantime, if you have any personal or corporate insolvency related questions or client specific queries, please don't hesitate to reach out to your local Worrells partner. Worrells has delivered specialist insolvency and forensic accounting services for over 45 years. We are available to discuss these matters via telephone or video conference, whichever is most convenient to you and clients. And just next slide there, David, if you may. And for other related services that Worrells can't provide directly, we can connect you to professionals within our network if their services are better suited to your client's situation. Thank you all again for joining us today, and goodbye for now from the team at Worrells.